Innovation is frequently mistaken for progress, but as the EV market stalls and Apple fights for every chip, we're seeing that $1 billion idea is only as strong as the infrastructure supporting it. In an industry where massive contracts are based on probability rather than certainty, the real power lies with those who have actually held the levers they're now being asked to pull. Join us as we break down the attitudes of retail leaders who rose from the assembly line to the executive office, how misjudging the market can tank a business, and how supply chain issues drain your pockets. This is Road to Riches. Thanks for joining us this week. I'm Neon Key Buchanan, and I'm joined by my co host, Matt White. Um, Last week on our first episode of the financial roundup, we talked a little bit about Apple and how, despite the fact that right now things seem okay with them, they've had quite a few issues in recent months when it comes to their rollout of Apple Intelligence and other AI features um, and things like that. Now we're actually seeing even more issues come out where, due to supply chain issues, Apple is struggling so much to get the RAM that they need, to get the other different chips that they need to make their iPhones, and even to produce further development within AI. Matt, you know a lot more about this situation and have walked through a lot of this in your head. What do you really think about this situation?
Yeah, so upon reception of this news that Apple is having a hard time meeting supplier demands with the iPhone 17, they expected a little bit of growth, but they did not expect the kind of growth that they're seeing right now. And so what they're having to do is according to a quarterly meeting. CEO Tim Cook has said that Apple is trying its best to acquire, for example, memory chips and chips from Qualcomm to power for their phones to try and stimulate supply of their product. And what's interesting about this is that this highlights a key economic point that haunts a lot of businesses, but you always have to be prepared for it, both on the demand side and the supply side. In this case, it's called a demand shock, where all of a sudden, spontaneously, there's a situation in which demand for your product just increases substantially, and there's no and it could be due to the introduction of a new product or updates to the old one, and it highlights a company's response when confronted with, in some ways, an unwinnable situation, like an increase in demand or a shortage of supply. And so Apple is trying their hardest to get their hands on memory chips. That is actually their bottleneck, and what they're learning is that the increase in memory chip prices on the market is actually making them dip into their margins a little bit. And this is kind of the key point that we want to drive home with this story is that Apple, not just Apple, but businesses run the risk if they're not prepared for certain market conditions that lead to demand shocks or supply shocks. The companies are left vulnerable if they don't prepare by having to dip into their margins. Another part of that article says that Apple has actually reduced margins a little bit, or managed to reduce margins a little bit, with the introduction of the iPhone 17. Well, now they're actually having to dip into their margins, decrease their margins a little bit, uh, because they're having to go into the market, purchase memory chips that are already inflated in price because of what's happening in the AI world. And And so that's kind of, so once again, that's the lesson I want to drive home here. That's the lesson that we wanted to tell, is that responding to market conditions, spontaneous market conditions, even though nobody knows when they're going to happen, nobody knows what's going to cause them. You know, it's very prudent for a company to be able to acquire their own acquire surpluses of their own inventory, acquire surpluses of material, or acquire backlogs of inventory, so that way they're protected from things like this, so that way they're not having to do what Apple is having to do right now. And Apple is by no means the the only company to suffer from this or befall to a demand shock, but they certainly are the nearest example. And so that's it. And so once again, looking at how the market can affect looking how the market can affect a company's margins, just off of the just based off of uh, a spontaneous rise in demand. And actually, in Apple's case, they are experiencing a little bit of a bottleneck in supply. Like I mentioned, the memory chips. It's it's certainly a very good management lesson, and it's something that, if anybody wants to make it up in the management world, or even start their own venture, they need to be aware that that is also a possibility.
Yeah, 100%. I mean, those market trends, you can do all the research you want, but that doesn't necessarily mean you're going to get it right. And I think that's one thing that Apple saw this year. As you said, iPhone 17 sales are off the charts, far and above what they expected. So with that in mind, you know, the lesson that businesses need to take from this is that vertical integration, where you're getting more involved with all aspects of your supply chain. For Apple, that's going to be getting involved with the mining of the materials that they need, then the processing of those raw ores, going into the actual processing of or manufacturing production of the chips themselves. That's all extremely important. And they have started that process. I mean, we all know a few years ago they came out with the M line, which is a in-house based chip for their laptops, iPhones, iPads, etc. Which, since they're not generic off the off the shelf products, then they're a lot more in tune to the needs of the device, and they're extremely efficient because of that. If Apple can now take a step back from that and say, we have the manufacturing process down, now let's try to get a bit more involved and invest more heavily in TSMC, maybe do a partnership with Samsung or Google or Intel or one of these other chip manufacturers, then that ability to spread out their supply needs is going to be extremely beneficial for them in the future. That's going to help manage these demand shocks quite a bit. They're going to have maybe not more supply, but now they're going to be able to manage their costs with it a lot better. And even if they later on decide to get into the mining side of things as well, then that's going to be even better. At that point, they're going to have essentially complete control over their supply chain for these. And don't get me wrong, it's going to be very, very difficult. And there's a lot more involved in making a phone or a computer than just the hardware, just the silicone hardware itself. These chips are very important. But you said a lot of good things in there that are in fact in here on this article. I mean, they write in this Wall Street Journal article that Apple still managed to project total revenue growth of 13% to 16% for the quarter ending last March. You know, they are still on a steady incline right now, as shown at the beginning of this article. At the time of writing, Apple's stocks were even up 2.6%. So investors are still excited for this company. They're still excited for the future. And assuming that their product rollouts, when it comes to their partnership with Gemini to make Siri stronger, when it comes to developing new technologies, whether it's new chips for the iPhone 18, whether it's making their cameras, which are already some of the best in the business, even better. There was always going to be some new feature or some new technology that their customers are going to want, and we just think that, or we just hope that, in the future at this point, since they have seen that they are susceptible to demand shocks, that they'll be better prepared for it in the future.
Yeah, certainly. And and I do want to bring up a little bit that, having Tim Cook at the helm in this case, somebody who's been with the company for a very long time, knows the ins and outs of the company, what levers to pull, so to speak, how to pull them, is quite beneficial to Apple, especially navigating this period, this period of slightly increased margins and a little bit of a corporate crisis, if you will. And one thing I wanted to bring up was, you mentioned their new M line for their Macs and their MacBooks, and I know for a fact that Apple wants to bring those into their phones. They've been a little bit involved of producing the chips, but obviously a partnership with Qualcomm and TSMC still regulates that a little bit. But as far as getting their computer chips away from Intel, that was a big step in the right direction for Apple. And you're right. If they do take this crisis and do with it what they did with the computer chips, and try to move the process into a more in-house development process, then they could be much more set up for the future. And that's kind of how corporations. That's kind of how real progress in terms of corporate margins and corporate progress is made, is that they get thrown into these crises, and they have and they have to fight fires, and they come up with bigger, and the ones who survive, that is, come up with bigger and better ways to deal with these things in the future. They document how to deal with these things if they ever come up. And again, you mentioned investor excitement around Apple, and what's not to be excited about. They have that partnership with Gemini, and they have the partnership with Gemini. They have now they hold worldwide supremacy as far as market share for cell phones over Samsung. And so I would be excited too, and I am excited as well. But moving into that mindset of who exactly they have at the helm and who they chose to lead them through this crisis. I want to direct our attention to another article that came out from this one from Morning Brew about new CEOs from Walmart and Target being chosen. John Furner from Walmart, and Michael Fidelki from for Target. And again, these are two men who've been with each respective company for a very long time, and they also, like Apple's CEO, have been with the company and know the levers, where to pull them and how to pull them. They've worked from the bottom and worked their way up. Mr. Fulner worked as a sales associate in 1993, part-time at a Walmart in Arkansas. And Mr. Fidelki worked as a finance intern and started in 2003. And so very, uh, uh, marathon careers, if you will. These men with these companies, loyal employees. And so, but what's really important is that Walmart right now is coming off of the heels of their last CEO, and their last CEO Their last CEO led them through several consecutive quarters of increased aggregate store sales. Walmart has increased their market share against Target, and they did great under the last CEO. And so Mr. Fulner is coming into this a situation in which the pressure's on, right? The pressure to do well, and the pressure, uh, for lack of a better term, the pressure of perfection. And Michael Fidelki is coming into it in the exact opposite situation. So Target, their sales have actually been a little bit on the decline, and in fact, I forget the exact number, but they've had some consecutive quarters of negative sales growth. And so they're coming off of in 2023 they had the huge boycott, and things of that nature. And so they're trying to come back, sort of reestablish themselves and redefine themselves a little bit as well. And so, but the real story behind this, not only that these men were chosen to lead, but why they were chosen to lead. Once again, they worked from the very, very bottom of their companies, and they worked their way up, and eventually they got their shot. And
All right, it's looking like Matt's having a little bit of a technical issue, so we're gonna keep going and hopefully he can get that fixed. Um, but as he was talking about, these are very, very different situations, completely opposite. It really takes a certain type of institutional knowledge to make things work on a large scale. When it comes to both of these new CEOs, they've been with these companies for years. They've seen what it means to be an employee on the lowest level, what it means to be in the middle management level, and now what it means to be at the highest levels. It's all about getting a true understanding of how the business operates. It comes to being able to know what the day to day is for the lowest levels. You know, if you're in the garden section, the garden department, then you're going to be able to see, number one, what does customer service look like for this organization? The people that are directly interfacing with our employees, that is the customers, are the most important people. So how do we make their experience the best? What issues are they having? How can we make their lives easier? That's what he learned at that level. And as he got higher, or as they got higher up in their management levels in their careers, then he can take that further on and say, well, now that I have a bit more power, how can, instead of making the garden section better, how can I make this store better? From there, how can I make this district better? Now, how can I make the company better? At the end of the day, Walmart prides itself on low prices. They have their rollbacks, and granted, it's that's less of a marketing point now, but the idea that Walmart has with trying to keep everything low price, trying to keep things accessible, that's what they're known for. That's what they have to keep doing. And of course, they have expanded their things a little bit. They are now truly trying to build out their online marketplace to rival Amazon. I recently also saw that Walmart has now become the 11th company to have a $1 trillion market cap, and at that, the only traditional brick and mortar retail store to do so. Amazon's market cap is literally 2.5 times larger than Walmart's is. So they have a very long way to go if they want to get to the top. But this is a great start for them. And even with Target, they did have a lot of controversy in the past, but that only means that Fidelki has a great opportunity to truly bring things back to where they were before these boycotts, and then go even further. And of course, again, that all starts with knowing exactly how the operation works at all possible levels.
Can you hear me?
Yes, I can. Go for it, Matt.
Awesome. So the larger part of this story that I did want to touch up on was, you're these men coming from the bottom, uh, and we've heard it before. I've heard it before. Nyanki has heard it before. You get into this mode where people tell you that things like this can't happen. That Ferner and Fidelki, they're the one-offs. They're the exception to the rule. This rule that you this rule that says that you can't actually work your way up from the bottom. This rule that says that the American dream, as it were, which is what this symbolizes, and actually what this is, the idea that you can work from the bottom and make a life for yourself. People discount it, and I've heard it many times, unfortunately, from some of my other friends, and to me, it's a little bit frustrating that they'll sort of look down on this idea and say, oh, well, these are the exceptions, they're not the rules. If it was really like that, then success would come much easier. It's like they're trapped in their own revolving door of it can't be done, or it won't ever be done for me, so why even try? And I wanted to bring this story up to say these two men did do it, and they are not the only ones. Jensen Huang, the leader of NVIDIA, he did it. Um, the And the leader of AMD, I forget her name, but she did it. Other names like Mara Barra of GM, who started as an 18-year-old, who was just a part of a cog in the machine, if you will, at a GM assembly line, who was inspecting fenders and hoods. I mean, and we the list goes on and on. Ursula Burns of Xerox, Karen Kaplan of Hill Holiday, and so that's what I want to try to convey. And of course, on this podcast, we want to try to convey that it's not impossible. That hard work really does pay off, and to not ever let anybody tell you that it can't be done, because it can be done. You just have to believe in yourself. Yes, it's going to take a long time, and I wish I could tell you that it wouldn't take a long time. There's places I want to be that I'm not, but it's a process. You have to trust the process. It increase what you know. Again, that's why these two men were chosen, because they had institutional knowledge. They knew how the entire process worked, and that's why they were trusted with control of a company. And you just trust the process, take a deep breath, and enjoy where you are right now, but also strive for where you want to be. And one quote that I will read off for you, from Ursula Burns, again of Xerox, is focus on where you want to be, not where you are. And this can be in how you dress, how you present yourself, and ultimately how hard you're willing to work for what you want. And I would encourage all of our listeners to trust the process, take a deep breath, and realize that if it wasn't hard, everybody would do it. And that if you really are working hard, if you really are doing what you're supposed to be doing, then you will be successful. It will just take time. Just be patient, and so that's the lesson that I wanted to convey with that story as well.
And that's a great lesson. Where I come from, we call that the idea of resilience. And it's that same resilience that brought these men to their leadership positions, that brought the others that you mentioned to their leadership positions. And it's something that we need in our daily lives. Um, but even with that, there's also the idea of economic resilience as well. People get angry sometimes, or frustrated, or all they come up with all these different emotions. They get scared when their portfolio goes down 5 or 10% in a year. They say, "Oh, everything is changing. I need to pull out and protect my money." If they with the recent pullback that we saw in precious metals, that 20-30% drop that we saw in silver, people who had a lot of money invested there might get scared and say, "Hey, I need to pull out my money. I'm going to lose it all." The economy always bounces back. Maybe individual assets, sure, like there is a possibility that whatever company you're invested in right now, let's say what if you have an ESPP, an employee stock purchase plan at your company definitely could go bankrupt. God willing, it doesn't. We hope that good things continue to happen, but if that company goes bankrupt, that is a real risk. That is a real possibility, which is why diversification is so important, which is why, for most people, individual stocks is not the way to go. You need to go with a mutual fund or an index fund, something that has that inbuilt diversity. Because overall, when it comes to an overall sector, when it comes to the overall market, one thing may go down, but the others are going to bring it back up. And given enough time, everything will recover. It may not be this week, it may not be this month, but 6 months from now, a year from now, 2 years from now, not only will you be right back where you were, but you're going to be even further ahead. Um, but something that we really do need to learn is that a lot of companies, and it was talked about a little bit with Target, they're making missteps on large scales. And that has to do with economic trends, with knowing the market. Who are my customers? And how do I reach them appropriately? What are the things that they actually want? And that's something that the EV market is going through right now and is really struggling with. Um, in recent months, there have been reports coming out about how EV sales have collapsed. Many of you may know that in September, the um, electric vehicle tax credit that was provided by the federal government has now been stopped. There is still the EV charging station credit, but that's significantly less than what we were getting previously. So there was a very large rise in EV purchases in quarter 3 of last year, and then a very, very sharp decline in Q4. Funnily enough, that one sharp decline in Q4, despite the massive pickup in Q3, ended up signaling for the entire market what's going to happen. Overall, EV sales went down around 2% last year. We see here in the market, it even reads, with government backed sales incentives revoked at the start of October, total EV sales in Q4 plunged to 234,000 units, down 46% compared to Q3 and 36% lower year over year. Sales in the final quarter of 2025 were at their lowest point since Q4 2022. We're seeing an overall shift in what car manufacturers are doing now. GM has announced that they're scaling back their EV investment and shifting more to ICE vehicles. Ford has announced that they are pretty much lost their entire investment of over $100 billion into EVs. At the end of the day, most people don't want an EV, and even a lot of the ones that do want EVs can't necessarily survive with them. The infrastructure is just not here yet. In California, there were stories about how they had essentially mandated electric vehicles. I want to say by 2030, but there have been so many failures of their electrical grid that it's just not feasible for that to happen. Eventually, we will get to a point where these new technologies can flourish and they are wanted on a large scale. But right now, the market just isn't ready for it, and these types of failures are things that good leaders are going to be able to see and push back on the people that are telling them otherwise.
Yes, certainly. And I know that not just not just Porsche, but also and not just Ford and GM, but also Audi and Dodge. They're also making strides away from the EV market and towards combustion engines again. And once again, like you said, that's necessarily not necessarily a point for combustion engines as much as it is a point against uh, electric vehicles. Once again, we don't have the infrastructure. We don't necessarily have and it's hard to believe, but in some cases, we don't necessarily have the technology for it. People we don't have the infrastructure, we don't have the technology. And the reason I say that is because some people are not satisfied with the range of these electric vehicles. And some of that is due to how heavy these batteries are, but some of it is also due to how much power can be stored in these batteries. A lot of power can be stored, but it takes a lot of energy to move those cars. And so all of that being said, we're seeing a movement away from electric vehicles by major companies towards combustion engines. Once again, a story for another time is, a lot of these movements is because they've noticed their customers are actually longing for those products that they used to make, longing for the 392 from Dodge, or the RS series from Audi, and on the high end the Audi R8, which they discontinued for the 2026 model year, but is supposed to come back in 2027 as a combustion hybrid. And so these, and you mentioned Ford and GM earlier, and so not only are they responding to the demand of what they used to make, of what was, but they're also responding to a receding demand in for electric vehicles, and they're also and responding to the lack of benefits for electric vehicles that electric vehicle supply customers, and they're reacting to as we call it, the external forces of the market, um, and an externality of the federal government reducing electric benefits is that those electric vehicle sales will inevitably go down. And so, again, this kind of teaches us a lesson in how companies not only need to be ready for things like demand and supply shocks and build up on their current inventory, but they need to be careful about what innovations they make, because their customer base might not be ready for it, or their environment may not be able to support that said product that they develop. And so there's a lot of factors that a company has to look at before they come out into the market with something. They got to think about, can the environment sustain something like this? Is there demand for something like this? And on that demand, is this demand long lasting? Can this demand last? And uh, in the EV lesson is that real consequences can happen. In Ford's case, billion-dollar consequences can happen if you go on this path where you make an innovation, but those three things that I just mentioned are not there for you. And so companies need to be wary of not just supply, but also, will the market demand this, and is that demand sustainable?
Yeah, I mean that idea of sustainability is huge because what we're seeing is that there is a difference between a trend and innovation. You know, even if we don't want to use the term trend, but we can call it a fad more or less. People are interested in electric vehicles. Don't get me wrong. There are a lot of people that love them, are diehard fans of electric vehicles. And I'm not necessarily going to say that EVs are better or that ICE vehicles are better. It all depends on your personality, your wants, your daily needs, the infrastructure in your area, etc. But you can't see these innovations and always immediately jump on them. This is one of the issues with event-based investing, where you will see basically everything that comes up, every trend, every fad, every innovation at some point is going to come back down. Right now we're getting to where the AI bubble is so large that it's about to pop. Some people back during the COVID pandemic invested in these medical companies and things like that, and they saw massive returns, but eventually they all came back down too. So you really have to ask yourself, what is it that I want? Do I want long-term returns and the stability that comes with seeking that goal, or do I just want to try and chase the whale, and hope I hit it big?
Right, exactly. You can't like we discussed with event-based investing. You can't just follow what's popular right then, because you don't know if it's going to continue to be popular in the context of investing. You don't know if you're going to end up holding the bag for these large whales, or in the case of EVs, you don't know if you're going to end up with large amounts of inventory that the market simply doesn't want anymore. And now you're looking at getting rid of it if you're lucky for pennies on the dollar. And that's not a good spot for anybody to be in. And this is a real risk for companies. Once again, Ford is billions of dollars in debt because of this EV fad, as you said before. It sort of is a fad in that demand came, by the way, in part due to some due to some government assistance. There were tax credits. There were tax credits not only for buying an electric vehicle, but also for solar panels and charging stations. And so there were some benefits, but the demand in some cases was very real, and people thought it was going to be the next big thing. There was a story about China, a company in China investing very heavily in electric scooters, and they end up with tens of thousands of electric scooters that they never sold, because the demand simply wasn't sustainable. And so once again, you can't go off of fads, you can't go off of trends, in terms of business or investing. You have to try to figure out for yourself and for the good of your company, is this sustainable? And is this sustainable? In other words, can I see people continuing to buy this product in 5 years, 10 years, maybe even 15? And it, can I continue to compete in the market if demand is sustainable? Is my product still going to be demanded? In other words, you know, the demand for electric cars and electric uh, transportation may be still in high demand, but are they going to demand your offering? And this is a now we're getting into a situation where Tesla is competing with other uh, solely electric companies like Lucid, and they're finding it a little bit hard to compete because Lucid makes a better, according to the market, makes a better electric vehicle than they do. And so, a lot of different variables to think about, a lot of different market variables, and you just have to try and make try and make as little assumptions as possible when it comes to things like this, um, and make a decision that way. But again, that's where a lot of people run into problems, and that's where you get dipping back into the Walmart and Target stories, that's where you have to have somebody who has real knowledge of an industry, real institutional knowledge of an industry, and real knowledge of the firm to be at the helm making those decisions.
Yep, completely. And we have just one small little story to round things out. Um, you know, there is, as I briefly mentioned, basically an AI bubble, and a lot of that is due to the fact that many of these companies just keep investing in each other, supposedly inflating their balance sheets, inflating their revenues, but they're not actually generating real tangible value for a customer base. I think I mentioned at some point before um, that OpenAI is recently starting to add advertisements to their LLMs, their models, and that's one way that they are able to start generating revenue from their AI services through their or from their customer base through their AI services. Um, but we have, Disney investing $1 billion into OpenAI and then announcing that in the near future they're going to start adding AI to their movies and their Disney Plus service. We have Nvidia investing a bunch of money into OpenAI, and then OpenAI just invests that money back into Nvidia, and then they turn around and invest in Oracle, who then goes and invests in Anthropic, who then goes back and invests in Nvidia. It's just a large incestuous web of mess that none of us really understand.
Yes, certainly. So this story that we're about to go over, the bedrock of the story is that you can't. The bedrock of the story is that you can't build an empire off of the prospects of maybe. And in this case, we're talking about Oracle building AI data farms, spending billions of dollars into this project based off of a $300 billion long-term contract that they've already signed with OpenAI. And so we're talking about Oracle making a genuine investment into AI, and continuing to build their platform and their infrastructure off of a maybe. There's concerns that OpenAI may not be able to fulfill their obligation to the contract. And what you were just referring to, this idea that Oracle and NVIDIA and OpenAI and Google, they're all funding each other. Well, there's some real truth to that. In this case, we're talking about uh, Oracle creating data farms, and of course, what are in those data farms? We're talking about graphics cards with chips made by NVIDIA and or supplied by NVIDIA, and then we're talking about NVIDIA investing in OpenAI, or purchasing LLMs and things like that from OpenAI. But we're also talking about OpenAI buying chips from NVIDIA to make their LLMs work. And so it's kind of it's certainly a circle of funding. And what what we find out when we really look at it that way is that it's very, very fragile. And if one of them does, for example, let's say that OpenAI really can't fulfill its obligation to Oracle. Well, to a point, maybe it'll work for Oracle where they can survive. They've counted on, okay, what if OpenAI can only fulfill 250 billion, 200 billion, but any more than that, the system will absolutely break down, because then Oracle will not be able to purchase any more chips from NVIDIA, who in turn won't be able to invest in OpenAI for the development of new LLM models. and OpenAI, because they can't fulfill their contract to Oracle. What makes us think that they're going to fulfill their obligations to NVIDIA or continue to purchase more inventory? OpenAI is not going to be able to buy any chips from NVIDIA, or if they are, very, very little amounts compared to what they were buying. And so, there's a very there's a very big elephant in the room that this model is not sustainable. This is a largely a self-funding model. And from what I can see from the story, I don't know if you agree or not, unless something changes, I don't foresee this sustaining long into the future. Something large would have to change where large amounts of funding is gained from somewhere else.
Yeah, I mean that's pretty much how things are working. Um, I do want to clarify a little bit when it comes to how the funding works, or how that necessarily affects their bottom line and their stock price, right? So when one of these companies invests into an AI company, that AI company is then going to say, okay, we have such and such amount of either accounts receivable, that is money on contract that's going to come in, or directly in cash balances, or that we put into other assets such as the servers in the data center, etc. Eventually, you get to a point where these companies have to pay companies that are not in this web, right? So if OpenAI has to pay their electricity bill, for example, speaking of electricity, here's your weekly piece of not investment advice. A lot of these AI data centers are beginning to use small nuclear reactors for their electric power. So talk with your financial advisor. Tell them that you want to invest a little bit into nuclear power companies. You might make some money off of that. I don't know. Don't listen to me. I'm not an investment advisor. But anyway, back to the point is that when these companies do have to now pay someone else, that money leaves the web, which means it doesn't circulate back over to Google, who then gives it to Nvidia, who then gives it back to Oracle. It leaves the money, or excuse me, it leaves the web entirely. And now the overall level of reserves for one of these companies is lower than before. Eventually, these companies will get to a point where they say, I've invested enough money and haven't received either value for my money in the terms of a product or service, or receive that money back in other business. And at that point, these things are going to collapse entirely, which is why it's so important for Google to support Gemini with ads and to throw it into its search, and to do the partnership with Apple through Siri, because those are ways that additional funding enters the web to sustain this model. But as you said, Matt, eventually it just will stop working entirely. And at that point, we're going to see that crash that we talked about.
Yeah, certainly a large AI bubble for sure would have burst at that point, which is unfortunate, but it would go to show the fragility of the system, and like I said, unless something changes, this will happen. But if something drastic does change, this situation can be averted. Personally, I don't want to see something like that happen. AI has been, I think, uh, especially us in the finance world would agree that AI has been pretty helpful in terms of financing and in terms of research and everything like that. But there's a very real possibility that something like that could happen, and so let's just be aware. And those AI stocks, they may be high now, but again, unless something changes, we could be looking at not just a market correction, but a full on collapse. Not wanting to sound the alarm or anything, of course, but so these things, these circle funding, if you will, is a little bit scary. So let's hope that something changes, and I'm sure they're aware of it, uh, and let's move forward from that.
I was muted. All right. But like you said, that's ultimately the big lessons for these businesses that are investing is we have to get away from the idea that value can come out of thin air essentially, and that circulating money is generating value. Um, we talked a little bit about what the individuals are looking up and how things affect them as well when it comes to prices of their phones and EVs and things like that, and all of that is ultimately where we stand, where we've seen the trends. Everything is getting more expensive. How are we going to get our way out of the situation? How are we going to be able to buy the assets that we want, to get out of debt if we are, and it all comes down to the big thing of know where your money is, have a budget, make sure that you're saving and investing appropriately, and just don't spend money on things that you can't afford. Don't spend money on stupid things, and eventually you will get to a point where you're doing a lot better. So whether you're coding a game in your garage or at the forefront of tech development, the difference between success and collapse often rests on the institutional knowledge of those who are at the helm of the company. Leaders who truly understand their industry know exactly how to respond to economic and market trends and survive demand and supply shocks. So please remember to like and subscribe the video so you don't miss any episodes in the future, and leave a comment for us. Hopefully, it'll get featured on the next episode. I'm Niamki Buchanan, your host, hosted by my co-host Matt White. Thanks again for watching us this week on Road to Riches.